Hey Jaro, it's Tom. I'm going to show you the trade today. So we're trading the Russell and we are 60 days to October expiration, which is October 18th. So what we did, here's the puts. We are at a delta of -7 or so where we sold these puts, and then we sold the 890s and we went 20 points lower to the 870s and bought 5 of those. So that looks like this. So it's basically a credit spread over 1 standard deviation away, so lots of room. Now to make the weird OR, we have to add in a debit spread. So we bought the 1,990 debit spread, and that changed it from the blue line to the brown line. So that gives it that characteristic weirdo shape right there. Now, another technique is to buy a way out of the money put, which we did. And this is a 2 delta, cost $130 or so. And that basically raised this up, as you can see. So if we had a big sudden move down, say to like here, instead of being down, what was that, maybe 900, we'd only be down 600. So it helps reduce things on the downside, and it doesn't cost that much. It's about a little over $100. But what it does do, it also offers you protection against really massive moves. So for instance, if we had a flash crash and the market dropped, say 20%, that would take it down to, I'll say around 800. If we didn't have that extra call, we would be down $6,000, and that, in this case, down 2,700. Now the markets have made even bigger moves than that. And what has happened with these puts on the flash crash, where it was like 1,000-point drop, you actually made money. Like a $4 option, it went to like 40. So you were up, over here, making quite a bit of money. So if the market really totally collapses, we'll have a big smile because things will be going pretty well. But if we look at it right now, the green line, let me just close this and just go back. So that's what the position is right now. That's the big picture. You zoom in a little bit. These are the standard deviations. So we have option view saying 88% chance of making money, which is pretty good to start with. Now, we were trying to sell some call spreads up over here, and those were, where are they? Not too far, I think. Oh, I don't even have them on here. So I was trying to sell one of these and buy one of these. And that changes it to look like this from where it is right now. So that just gives you a little bit extra. It helps change the delta from 2 to -3. So it leans a little bit short delta, but it's pretty flat either way. So it's not too critical if we look at without the calls or with the calls. So you see it raises this up just a little bit. So here, if it stays in this range, we would make $328. If it closes down in this range, it would make $1,300. And without it, here we'll make $170, and here we'll make $1,170, $1,169. Now, ideally, we'd like it to kind of hang around here and get near expiration and just kind of end up over this area. But we'll see where it goes. It looks like the market's trying to sell off a little bit. It's kind of going down. So if I look at the birdie in option view, this shows the profit range. So you see if it has a really massive collapse, we can actually do pretty well. But we have a pretty good range at expiration for this thing. Now, without the calls, let's see. Oh, I gotta do like this. Now if I go back and put the birdie on, you'll see now there's no losing anything above here. So as long as it just maybe goes down a little bit and then sideways. This whole area is where you make your money. And anything above here is basically the same because that's the, where is that? That's this strike right here. So your break even at expiration would be, 887.66. You can see one standard deviation down is 903. So we have more than one standard deviation at expiration. Now remember, this is a 60-day trade, so this is a lot of room. And again, if you look at the birdie, that's how long it takes. So this is going into October. Now we can get our money if it just stabilizes and stops here and volatility comes out. This is a short Vega trade, so we're short about, well, if we get these calls on, we'll be short about 60 Vega. Right now it was 30. But so if volatility goes down, then profits will go up, and I can show you that with option view. I'm going to assume we get the calls on tomorrow. So now if I, oh yeah, well that's a nice thing with option view. How do I do that? I'll click on the voltage change. They have this horizontal volatility cone thing. It's kind of new. But if I drop the volatility by a couple points, say -3 points, notice how this graph jumped up. And maybe I'll go -5. See, it jumped up again. So let's put a few expiration lines on here. And one thing you'll notice, if volatility stays the same, as we get in closer to expiration, I can zoom this in so you can see it a little bit better. Notice how this line is kind of what we're trading for. So that is T plus 40, which is September 28th. So a little bit over a month, maybe 5 weeks from now. If we can get to this line, we'll be in good shape. You know, we'll make somewhere 5 to 6%, something like that. So if I have this selected and then run this cursor over to it, you can see, if you look where my mouse is, right about there, you'll see the profit. So 550, maybe even 600 up in here. So 600 to 500 range, something like that. That would be nice. You know, it doesn't necessarily have to be 300. Anything between like 1040 and say 940. So you have a 100 point range, and I can even put a target on there. I think that's it. No, used to be a thing in option view called target. I don't know where they put that now. Let's see. No, that's not it. All these buttons. Oh, that's kind of an option net kind of thing. It's interesting. Okay. I'm sorry, I don't know where that thing is. That's projected dates. That's option expiration. I can't find it. Bell curve. Oh, here we go. Target results. That's what I'm looking at. So if I'm looking at price range, so 944 to 1040, and that's on 1018. That's the range that we're kind of shooting for. And today the price Russell is at 1013.25, so that's 1013.25. Okay, so 1013.25. So that's where the current price is right now. So ideally we'd like it to be right in here. That's where we're going to try and maintain it. Now, something else that I want to show you is what are we going to do Okay, so now the next question is, what do we do if the market moves? Right. So if we get these calls sold, that's $1.50 roughly. Then oh, yep, our order just expired. Okay, so the this call order. So if we sell this for $1.50, if the spread goes to $3, we would just close it, and just we're not going to spend a lot of money defending that. So actually, right now we don't have these. So this is what our position looks like right now. So actually, get rid of these lines. If the market starts to rally back up, we don't really have to do anything. We could even, move this debit spread up, or just close it if we don't need it, and recapture some of the money for that. So, say for instance, the debit spread, if we took it off, then the trade would look just like this. So then you'd be making about $500. Obviously, we'd have to wait, because if it's going up, this will lose a little bit of money, because by itself, let me show you what it looks like. That's just this debit spread by itself. So that's $335, and if I let it go up, say around here, 10, maybe 20, 30 points, it's going to lose $120 of value, and then we can just close it and take that loss, but then we'll sell the rest of this. So basically what would happen is, if we did do this, we'd have $120 of loss, of less profit. So we'd have about $380 of profit over this whole range if it starts moving up and we close the debit spread. Now on the downside, if the market starts moving and it goes down, then we need to defend this. We want to keep this line fairly flat. So what we'll start doing, say it moves down to, say it gets down to here, this area, then we'll add another debit spread, probably close to the money, maybe something like this, and then we'll go maybe 15 points wide, or 20 even. And that would change the shape of it more like this. But remember, we would be down in this area already, so we would be flattening this out. See how flat that is? And if we superimpose it, we're just raising this up, so we're just adding more room to make money down here. And if it does stay down here, we can actually do pretty well. We don't want it to get too close, because disaster looms over in this area. But basically, if it starts moving down, we'll add a debit spread down here, and if we need to, we'll add another one, or even take off some of these short puts. So if we had another debit spread and it kept moving, we could buy in one of these short puts and then change it to more like this, so it's even sloping really up now. So basically, we'll react to the market and see what the market does, and add debit spreads on the downside and close the calls on the upside. We're not going to try and really defend those calls very hard. So hopefully that makes sense. And again, here's the big picture. Here's the standard deviations at expiration. I don't think that's right though. The volatility's higher. Let's say, I'll just say 30%. So that's about a little over one standard deviation away. And if I look at Thinkorswim's analyze, they're saying one standard deviation is at 932.69. So 932.69. It's about here. That's what they're saying one standard deviation is. And this expiration point in Thinkorswim looks like it's about 1.6 standard deviations away. So it's pretty far away. And that's about where you want it for a weird order. So that's kind of the trade. Hope you like it. And we'll let it bake off, and hopefully in 4 to 6 weeks we can take it off and we'll look for another one. Thanks a lot. Bye.